Welcome everybody to the T3 Alpha Show. This is a very, very, very special episode. My name is Michael Comeau, and I am here with Michael Sedacca, who is I don't know that I'm going to call you my Fed whisperer because he is my absolute top macro guy. We used to be partners in crime at Minionville way back in the day. Now he is a portfolio manager for Rareview Capital. So Mr. Sedacca, how are you doing today?
I am wonderful. It's a pleasure to see you, Mr. Comeau.
All right, so I need to know what the hell is going on with the Fed. I'm seeing the Fed Watch tool saying 74% of a chance of a December rate cut. It seems like the market is all over the place. Like, what do you think the Fed is doing?
Sure. Yeah, they're right now they have two mandates. One is inflation, what they call price stability. The second one is unemployment, which has a little bit more of the growth side of things as well. The unemployment side, or the labor side of it, certainly is very weak relative to what might be stable employment. And inflation is above target, but not too far above target, and it is coming back down towards 2% again. So between those two, that argues for one being on the weaker side, one being on the stronger side, and they should have about neutral policy. So they think neutral policy is about 3% on the Fed funds rate. Currently, as it stands today, it's a 4% Fed funds rate, and they're trying to get down to 3%. Of course, there's differing views. There's 19 people on the Federal Reserve, probably 4 of them only really matter, but of course, we get the airplay of the other 15. They're trying to figure out how fast they want to get down to 3% from 4% right now. They've cut interest rates by 50 basis points in the past 2 months. They're trying to get down to that at the moment. Because there's been an information vacuum since the October Fed meeting, with the government being shut down and virtually no economic data being released, some Fed members of those other 15 are getting more airplay and more prominence because the market doesn't know what to do. It thinks the Fed should cut, but it doesn't really care whether it's next month or 2 months from now or 3 months from now, getting to that ultimate endpoint of 3%. That's what we're dealing with at the moment. And it's been more all over the place because the October and November inflation reports and October and November employment report won't be released until after the December meeting. So it all becomes driven by what is the most recent Fed member saying and what are they not saying. And as Jerome Powell hasn't spoken since the October meeting, and he's not going to between now and the December meeting, as a result, his most recent comment was, we don't know what we're going to do in December. So it's jump ball. This morning, New York Fed President John Williams said, seems like a reasonable idea to cut interest rates in December. Facts haven't changed in September. We had greenlit a total of 75 basis points of rate cuts this year, and we've done 50. So that's where we're standing right now.
So do you think they actually cut in December? Because, I'll say this just because to me it seems almost, now that I think about it, it almost seems obvious that they should wait and see, because if the data's not coming out until after the meeting, shouldn't they wait? I don't know. But back to the question, do you think they actually cut in December?
Sure. I don't see why they shouldn't. And there's two ways to think about that, because that's more like the gambling component of financial markets. From an investment perspective, you really care about where they're going. How far are they going to cut interest rates? If they're only cutting 25 basis points more and stopping, well, that's very different than getting down to that neutral rate of policy, which is 100 basis points more of interest rate cuts. Every bond instrument besides a very short-term T-bill, like 3 months or less, is discounting what they're going to do over the next 1, 2, 3 years. And the 1, 2, 3 years is, are they getting to 3% or 3.5% or 3 3/4, 2.5% for that matter? And we think that they're going to get another 3%. That's a very tactical conversation to determine, is December, that's binary outcome. Is it A or B? It's more about where are we going, because if the market's only pricing them in general cutting to 3 3/4 or 3.5%, and we think they're going to 3, well, there's a minimum 50 basis points lower in yield across the curve that's going to be taking place, and that's principal appreciation in bonds. And there's no argument for interest rates to be in general higher from where they are today, just in general.
Okay, so when you're looking out there, because if you're looking to allocate assets, is this kind of uncharted territory? Because first, again, we have the data not coming in, the tariffs, God knows what's going to happen. Plus Trump is the ultimate wild card. Mm-hmm. So does your time horizon have to be shorter just because it seems like there's just so many more balls in the air these days?
I don't think so, because you can keep it on a thematic long-term approach where you don't have to worry about those short-term balls in the air and focus on what's taking place. What's taking place with the consumer? The predominant driver of the economy. If the top 10% are doing great because they own a lot of financial assets and the stock market's up 100% in the last 3 years, and their real estate's odds up to 50% or so in the last 5 years, they're doing quite well. They feel pretty good about themselves because they might have stock-based compensation, or their wages have caught up, or their overall net worth is caught up with the level of monetary inflation. Other 90% are struggling from tariffs, as you referenced, or in general higher interest rates, or tighter credit spreads, or credit conditions, or higher costs of the things that you need every single day, with less ability to absorb those higher costs in a rapid fashion like the other part of the consumer can. So that is the difference maker right now. And frankly, whether the Federal Reserve cuts interest rates by 100 basis points tomorrow or raises them, I don't think that really changes those things. So I think that's also an important consideration.
Okay, all right, everybody. I feel like this is a common issue with like any kind of bull market, whether it's in bonds or equities. People are obsessed with calling the top. Like we were joking offline about the TBT mafia. Now, when we worked together in like the 2010s, every stock market guy was buying TBT because the argument was what goes up must come down. The bonds are going up, they got to go down eventually. Now,
Right.
I keep hearing about like the yen carry trade. I think people are starting to talk about it again. Jeff Gundlach is talking about private credit being a bubble, comparing it to subprime. Like, how stable is the system overall?
Yes, private credit or leveraged loans or direct loans of that kind, as a percentage of the financial system, is as large or larger than subprime was back in the early 2000s. And we've tracked 17 different bankruptcies in the past 3 months related to that that sector of the financial system. And on top of that is I think it's widely reported at this stage that there was a CLO from BlackRock that basically broke its shelf. It's a $500 million CLO. That's been a significant amount of money that's piled into that asset class, because after the Federal Reserve raised interest rates by the most aggressive amount of all time in 2022 and 2023, for that matter, a generic core bond portfolio had its worst drawdown by a factor of 4 ever as a result. Partly because interest rates are coming from zero, so bond prices are significantly more sensitive to changes in interest rates, and because they raised rates so quickly. So the average investor, or most investors, said, we don't want duration risk anymore. And because interest rates at the short term became so high, they're like, hey, I can get principally protected 5% or 5.5% and that's generally meets my client's goals. And then, of course, it's the financial industry rather. They came up with a investment. You want short duration bonds? You want to take a little credit risk? We got something for you. It's called CLOs. CLOs repackage and buy single B high yield leveraged loans, or private credit, which might be probably unrated, with dicey financials, no unaudited dicey financials, and no access to public markets. That asset class 4 years ago the underlying asset class was about 1.4 trillion. CLOs and private credit now dwarf the underlying asset class itself. So it's created a market unto itself that it's the mirage of AAA rated or AA rated or single A rated paper because you own the highest tranche. But underneath it is just very risky investments. And I'm sure that reminds people, like you said, of subprime. That's why Jeff Gundlach will probably reference that kind of thing. And it highlights that the underbelly of the consumer is very weak at the moment, whether that's related to jobs, whether that's related to the inability to deal with inflation, lack of wage increases, or D, all of the above.
So like the CLO you talked about, collapsing. Do you think that's a canary in the coal mine?
I hate that word. I mean, I think that's for the credit asset
Listen.
classes.
I apologize. I have to go for the cheap soundbite.
I know.
And
Uh,
in all fairness, your dad,
I
so
know.
Mr. Sedacca's father, was one of the earliest people to say he was. I don't know if it was Lehman Brothers or Bear Stearns, but I know he was very, very early. I
Wachovia,
believe.
all those things. Yeah.
Yeah. So your dad picked it out correctly. I was wondering if you would if you would echo it,
To
but
see
no,
it's
I
it's
mean, like in all seriousness, like it is silly to like try to predict like the system's going to die tomorrow. But I mean, like, is it a legitimate sign of trouble? Maybe
it's
is a better
legitimate
way to
sign of
ask it.
trouble for the credit markets, without a doubt. How that plays in the S&P 500, given the composition of the S&P 500 these days, is extraordinarily different than it was 20 years ago. Now, I think it's worth talking about, but nonetheless, the top 50% of the S&P 500 are negative net debt companies, meaning they have more cash than they have debt. In the case of like Microsoft, which I think is number two or one, two, or three in the S&P 500, it has more. It has 4 times the amount of annual cash flow than debt outstanding. So they could pay back their entire debt in 1 quarter. 20 years ago, the companies made the S&P 500 were extremely debt heavy. So they were relying on repo borrowing. So when the repo markets closed, they couldn't keep their businesses operating. It doesn't matter for Microsoft and Apple and potentially Google and Meta and Nvidia. And that, I mean, we can make the thing with Nvidia is its own deal. I mean, they don't have any really debt, but what they're worth or what they're not worth is, I'm sure, up for debate, as people like to debate that until they're blue in the face. So I think it's different. I mean, it's very negative for the credit asset class as a whole. Does it mean the world's going to come to an end? I don't think so. I think it just means you just avoid investing in those asset classes, or you avoid investing into riskier bank stocks, or you avoid into consumer stocks or in BDCs for that matter. Those are the things you avoid. You don't just
Okay,
go
so,
to cash.
okay, all right. So you talked about the like the composition of the S&P changing, and the big theme the past couple of years has been AI, which I mean is also having it. So even though the big companies, at least the like the Mag 7 type stocks,
Mm-hmm.
produce tons of cash flow, but there is a lot of like goofiness going around with related party companies. Like, you own the
Of
bagel
course,
store and then I sell you the flour, but then I buy the bagels from you too. Or, it's
of
like, it's
course,
this, I mean,
of course.
that stuff, like it just, like it smells a little funky. That's just the way, I think of it. But like, I mean, like, so do you consider things like when you're thinking about the economy as a whole, like the AI, like CapEx spending boom?
A little bit. It certainly is driving the entirety of the spending in the S&P 500, and not the entirety, but is the marginal driver of economic growth at the moment. And it's different. So going back, I wanted to kind of address this about the composite S&P 500 is they have lots of cash flow, they have lots of cash, but they're choosing to, rather than use all of that cash flow, they're choosing to take on debt. And that's going to drastically, in my opinion, change the earnings trajectory for the U.S. large cap as a whole, and the investment grade corporate bond index, because investment grade corporate bonds, Meta and Apple and Microsoft and Amazon and those companies, their debt trades about 10 basis points over treasuries, because that's just whatever the de minimis risk premium that you take paying over treasuries, because they have such high cash flow, like they could pay their debt back in a second. Well, they're issuing and they're going to continue to issue a significant amount of debt to fund this AI infrastructure growth. So before, when they were spending, it was all cash flow. Now they're taking on debt to do that. And if something goes wrong, if we don't realize our hopes and dreams on AI, it's a different thing when you have to pay off debt to do that, when you put yourself with all your capital expenditures to get there. So I think that's a big shift that's going to take place. More importantly, in the corporate bond index, where the spreads are like in the 99th percentile, those are going to widen, because they have to own all that new debt, and it's going to come at a much wider spread than it has. Like the Amazon price debt 40 basis points wider than its existing debt was, because they had no debt. So if you have $5 billion in debt and you put on 20 billion more, you're a very different company, even though you have like 4 trillion or 3 trillion or whatever the number is in equity market cap, they don't have a ton of cash flow. So it's reevaluating that general theme of the market of high cash flow, high cash companies that have very little debt. They're going to have significantly more debt, whether it's on balance sheet or, kind of what you're saying is off balance sheet. In the case of Meta, where they issued $60 billion of off balance sheet debt.
But I mean, like, are those, because if those bonds are being priced at like very tight spreads, like relative to treasuries, like, are they even worth buying?
No,
like,
no.
because that's what I was wondering. It's like if
you rather buy treasuries in that case, because then that's always been our view is why buy that kind of stuff when you can buy treasuries and not take any risk. It's like, why buy a CD when I can buy a U.S. Treasury bill? What's the point? You're just taking on such level of risk of not being paid back for like such small amounts of money. I do like Oracle debt. I know everybody hates Oracle debt. I don't get why it's being traded like a high yield company, but that's a good one.
I mean, it's sort of Oracle. I mean, Oracle's a really interesting case because I feel like it feels like everybody turned on it all at once.
Yes.
Like it had that huge earnings report, and then all of a sudden, and then a wave of good news, and then all of a sudden the stock's collapsing. I see the headlines about the CDS prices going through the roof.
Yes.
I don't know. It was almost like I am a conspiracy theorist, so I will say it felt a little bit engineered.
It is engineered. I mean, that there's only $6 billion. I don't remember. I think it's $300 billion is what OpenAI committed to them. Only $6 billion of that's guaranteed. Yes, I mean, and then Gemini 3 was that 2 days ago was released from Google, and that might put OpenAI away, and OpenAI's on the hook for if they say they're going to pay $2 trillion of capital expenditures over the next indeterminate period of time. Well, what if Gemini 3 is going to be much better than ChatGPT? Are they still going to have that potential future revenue or be able to raise capital to continue build out? Maybe not. Of course, thinking about 20 years ago, the top 10 banks at the time, back then, not the top 10 banks now, like half of them don't even exist. So yeah, in 10 years from now, could the AI companies not, what are the top 10 now, not be the top 10 in 10 years from now? Of course. And that's what will take place.
I think Sam Altman might be playing the Elon Musk game.
Fake it till you make it. You're always a big proponent of that.
Yeah, like from a marketing perspective, it makes sense because like nobody's really gonna care if if they only spend 50 billion with Oracle instead of 10 trillion or whatever it is. It's like nobody's gonna check.
Yeah.
So it's like, and it's good for them to have the image that they are the superpower. But it is a very, very smart game from that perspective. So speaking of AI, have you found use for AI in like doing your actual research and your analysis?
Not particularly. Definitely. I think what you mean is large language models. You don't necessarily mean AI because there's a lot of coding that is already AI. It's been coding. It's been that way for 20 years. Nothing changed with that. There's a new tool in Bloomberg that they have basically their own chat GPT of Bloomberg that you can just type it in and figure that kind of stuff out. Yeah, and it certainly is helpful. I'm sure you find it that's that same way for marketing. I don't really find it that way for portfolio analysis. It's all already quantitatively driven, and there's a little bit of art of investing anyway that can't be replaced by AI.
Yeah, I've had so many issues with hallucinations and errors, even basic things like insisting that the all-time high in it was like a couple months ago, it insisted the S&P's all-time high was like 4,400.
Oh.
And I've even had situations where I put numbers into ChatGPT and said, give me the average and very basic calculations, and it got them wrong. Like it literally calculated things like averages wrong. And I don't know. So, I'm still somewhat of the opinion that a lot of what we think is AI is just like brute force computing. There's no actual reasoning. There's no reasoning going on.
It's just it's a more proficient version of Google. That's for like maybe but it helps write marketing content, but it's just stealing other marketing content that's out there. It sounds like it for you much faster. Like I think that's a great way of saying it. Just brute force computing.
Yeah, it's more of and as far as writing goes, it's really just an instant template generator.
Yeah.
That's what everything feels like. If you looked at like any kind of like writing or marketing software, it comes with templates. That's what everything with AI sounds like. Though, since I am a writer by trade, it's like I'm talking my book. It's it's what I want to believe because I had a good conversation with a friend of mine earlier. It's like when people say AI is a bubble, it's another way of saying I haven't made any money in AI. Like
right.
I watched Nvidia go from 80 to 200, which is literally what I did. I sold it at like 100 and then it went straight to like 200. I'm like,
of course,
yes, it's a bubble.
Yeah, like there was the same thing with GameStop. You know, it's like went from like what $10 to $300. It's a bubble if nobody has it because they're jealous that they don't have it. They didn't make the money. Yeah.
Yeah, there's
that's what that is.
Like a guy named James DePore who goes by Rev Shark. I remember years ago he had an amazing quote and he said it was like in response to a perma bear and he said like low quality stocks are stocks you don't own that are going up.
That's true. It's very true. Yeah, like if you don't have it and you're jealous. Yeah.
Yeah. Okay. So how do you I've been thinking lately a lot about the process of researching just about anything, and I think for a lot of people, research is just an exercise in confirmation bias.
Of course.
It's I think I see this like if you're a gold bug, low inflation is good for gold, high inflation is good for gold, the world's coming to an end is good for gold, finding 10 trillion kilos of gold is good. You know what I mean? So how do you actually like stay independent when you're trying to make an investment thesis?
I think it all comes down to being mathematically driven versus qualitatively driven. I think that's the biggest part of it all is not letting that kind of stuff be a determinant in it and trading. I think trading two ways across any asset class is by far and away the hardest thing that it took me to learn over time. And it didn't happen overnight. It didn't happen in 5 years. It took much longer than 10 years. And you lose money along the way to do that. There's anybody who says otherwise is just lying to your face. So that was the process that took place in determining a process that worked, that had a hit ratio. 65% is extremely good in financial markets. Like 100 is never going to happen. 70% would be astronomically good. So finding that is that's and not having dogmatic views about gold or crude oil or China or Japan, like the Japanese yen carry trade. It's been blowing up for like 25 years, and here we still are. I mean, hey, like whatever sells for somebody to sell blood and that kind of thing. I think that's the biggest part of it all. Just making the intellectual 180 when say things are going really bad, making that one, and you're in the camp that things are going to continue to be bad. Making that 180 to say, oh, things are going the other direction. You don't have to ever catch the top. Like whoever catches the top, because it's how many times were you wrong to get there? Because being wrong, unless you just have infinite money or you're not doing this for a living where your clients will fire you for being wrong. That sounds great. That's just words, in my opinion. You want to make sure you capture 80% of the move on the up and miss 80% of the move on the way down. That's heroic. That's the way I look at it. Versus, I have to have a strong opinion on gold, and then confirmation bias. It's just always challenging yourself or being around people who will challenge you, to say that you're wrong and that you can accept that you're going to be wrong in life. Of course, everyone's wrong. That was one of the things that my father told me. That's the one thing I remember from his writings is everyone's going to be wrong. And statistically speaking, if you're really good at what you do, you're going to be wrong 40% of the time.
You know what? Like, I think a great question to ask. I mean, for anybody to ask themselves is like, what major thing have you changed your mind about?
There you go. Yeah.
Because there are. Because I do think there are a lot of people, especially in markets, that just attach themselves to one random thing and they go with it for. Listen, I've been there myself. I'm not gonna like bullshit. Like, trust me.
Oh, me too. I mean, yeah. I mean, come on. As if I've never been there myself either. That's just being
Okay.
blind.
Are all of your decisions are quantitative and model based?
I would say 90% of the decision making is quantitative and model based. There's 10% of like the art of investing and the art of trading. And I can remember one is we had identified that there was a significant deposit outflow from the banking system in 2022, and it wasn't going to stop based on the level of interest rates that had gone up and what people could find. It just, it's the speed of money. You can move money from your checking account into the Schwab money market fund in 30 seconds, literally. So why would you sit there and earn zero when you can earn at the time 3, 4, 5% in that Schwab money market fund? Well, we could identify that at some point, didn't know when it was going to be, didn't want to trade against it until it showed up that was going to be a problem for the banking system. And then Silicon Valley Bank one day, is after hours, it's very vivid, recent memory for me, announced they were taking a $21 billion hit in the securities portfolio. And I knew exactly what to do because I was ready. I prepared in advance about what trades needed to be taken and be actioned when I saw that, and traded at 4:15 p.m. Eastern time after it came out of 4:01. There was a lot of model work that was done in advance of that, but the art of that trading was knowing that it took place, connecting the dots very quickly, and acting on a sizing perspective. So the sizing of that, the instruments are all codified about what they were going to be. But acting in a 14-minute period of time there's no machines. I mean, I'm sure there is. There's all sorts of machines out there that can do that kind of thing. But we're not that big enough to have like the mainframe computer who can make a decision for you in 2 seconds. But anyway, that's an example of you marry a fundamental, quantitative, systematic process to the art of investing and the art of trading.
Okay, so are there times when? Because I think everything like this, there is a very real human element to it. Otherwise, you would just program it into a computer and not even go to work. But are there times where, you put all your assumptions in, you do all your analysis, the result gets spit out, and you just say this feels wrong?
Yes, of course.
It just smells wrong.
Hey, we shouldn't be 40% in Turkey. In like Turkish government bonds. Okay, well that one doesn't make sense to say maybe we shouldn't do that. Yes. There's of course. There are we have one fund that's 100% systematic. There's no human input in that ever, and there never will be.
Is there a temptation?
Of course, I'm a human being. I mean, who isn't a human being to say that kind of thing? That's like saying, if you were dangling $1 million of cash in my face, would I be tempted to take it? If you said, no, you can have that. And if you took it, I would chop your arm off. Well, of course, I'd be tempted.
Yeah, I do think with systems, it's a little bit different because like if you built it and you use it, like by default, you trust it.
Yes.
I mean, this always... because one of the biggest things that fascinates me is rule breaking. Because I've seen a million cases of people saying one thing and doing another. And I always think of the same thing with models, like how tempted it... Because, it's like, the endless cycle. It's like, well, if I screw with it, is it going to be the one time I'm right, or am I going to immediately regret it? So I'm just like, I'm always fascinated by...
Yeah, I think there's a difference between there's certain processes that are 100% systematic, but you also are learning and updating those over time, for the markets are always changing. Something that's today might not have been the exact same 30 years ago. Things have evolved over time. And secondarily, I can think of very recently where it flagged private credit or leveraged loans or BDCs are becoming very cheap. But that was like 8% ago, and it was just an observation to say they're becoming very cheap for a reason. They're going to stay cheap. We don't need to be a hero to try to pick the bottom when it becomes cheap. And I feel like it's the same thing for people who want to sell blood and say, hey, markets have gone up too much. They're going to stop. It's like saying, hey, here's a railroad tracks, and there's a train coming, and I think they're going to stop on this railroad tie versus this one. well, if you're laying down there, you're going to get run over by that train. But at the end of the day, all you got to worry about is once the train stops, okay, then I'm out. But once you know that, great, you've missed the first. I'm saying like if something's going to go down, whatever it is, 10% of that move off that high, that's fine. But if you miss 90% of the up move, it goes back to your example of the Nvidia thing. I sold it at 80 and went to $200. I missed 150% return. I missed the entire move. Thanks for playing.
every at the end of the day, everything it becomes a because I heard a great quote that all accusations are confessions, and that's where I got that from. It's so people tend to accuse other people of the thing they're guilty of. So it's like, so it made me think of that. It's like, yeah, like why do you think AI is a bubble? Maybe it's because you sold Nvidia 100 points ago, you moron. Like that's I had the conversation with myself. Okay, sorry. So when you're looking at, let's just call it 12 months. Like, where are the most attractive opportunities in fixed income or whatever else, or even if it's just cash?
Sure, I think within equities, it's the nuclear power theme. I know there's a lot of hoopla on Oklo, and that one gets a lot of attention. But that's one stock out of 100 that are involved in that. U.S. and European defense spending. I'm sure it's well known at this stage about how much money Europe is spending on defense, and it's just going to keep going. They've committed for 4 years of that. Those companies, while they've gone up a lot, just that theme is not stopping. On the fixed income side, and kind of on a multi-asset basis, the emerging market debt and emerging market currency, specifically Latin America, places like Brazil or Turkey or Egypt or Argentina. Argentina's stocks too, to a certain extent. They have very, very high interest rates. Mexico would fall in there, Colombia, those kind of places. And avoiding China, importantly, those have significant opportunities. I mean, it has been very strong. I think Brazil, debt is outperforming the S&P 500 this year. That's pretty.
Why avoid China?
Their interest rates are like 1.5%. So they'd be poised to raise interest rates if anything. And just similar to how Russia was, I don't want to be invested into a country where first I'm getting less than treasury. So what's the point? Taking currency risk on top of that. And potentially, if the United States and China no longer have relations, then I may never be able to get my money out of China, and I might be like a Russia situation where I've lost the entirety of my money. So I don't see any upside whatsoever. That's an asymmetric risk against me across 3 different fronts.
Oh man, I own FXI. I was thinking about selling it the other day.
I can't give you recommendations on a podcast with Comeau.
You can't give me personal investment advice?
No, yeah. Maybe, if we had the investment management agreement, all that stuff, maybe we could talk about it.
All right. Okay. All right. So everybody, if you're enjoying this conversation, please like, comment, and subscribe. I put a link to follow Michael down in the description below. Okay. Before we close out, it is time for some rapid fire questions, starting with everybody's favorite question. What is your favorite Wall Street related movie?
Margin Call. Easy.
Excellent.
Yes.
I keep going between that and Trading Places, but I think Margin Call is so underrated.
Margin Call is good, yeah. That and Boiler Room. And those are just 2 classics, 2 great ones.
Okay, what is your favorite breakfast food?
Oh man, bacon. I mean, that's like about my top 3. Yeah, bacon, Aquina Ma, and pheasant.
Pheasant.
Yeah.
Wow, you're such an aristocrat now.
Land Jaeger. It's. I mean, you can smoke it and make it into sausage called Land Jaeger. It's the best.
Oh, do you have one of those pellet smokers?
Yes.
Oh damn it! I'm gonna have to come up. I'm gonna have to come up and invade your house.
Oh, you should. I mean, I was out hunting on last Sunday. I got 20 pheasants worth of food.
Really? Oh, and you hunt it yourself?
Oh yeah, hunted and cleaned it myself. Yeah.
Excellent. Okay. Who is your investing hero?
Oh man. Vince Foster. You remember Vince?
Yeah. Okay, all right. Final question. If I gave you $1 million and you had to put it in something and hold it for 20 years and yada, 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 this is not investment advice, blah, 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 blah,
Yeah,
blah.
yeah, yeah.
What would it be?
30-year treasuries. I mean, that's too easy. It's guaranteed return. But
No,
S&P 500, I mean, I would say S&P 500 because we're going to keep creating money and we're going to keep innovating as a country. Pretty simple. I mean, if I have no risk tolerance for 20 years, yeah, I'll pick the. I know it's boring, but I prefer to compound 8.5% a year for the next 20 years. It's pretty good.
No,
I mean,
I
6 times my money, something like that.
you know what? I'm starting to think that question is a Rorschach test. For
It is a Rorschach test.
It automatically tells you something because I know I've one friend. He said Tesla, and his thinking was it's either going to go up a lot or not at all, and he's willing to take the risk.
Yeah, I mean, you say the same thing about 30-year treasuries. Like 4.75% right now. You compound that over 20 years, you're going to, guaranteed return of 3 times your money, something like that. I could do it on my head, but something in that ballpark. Yeah.
Okay, Mr. Sedacca, thank you for joining me. It is a true honor. We will have to do this again.
Well, I would love to do it again. Thank you for having me, Mike.
Thanks.